Welcome to Notepad. I'm your host Ibrahim Sani. Tonight we have a treat for you. Permodalan Nasional Bhd (PNB) is in the studio with me today, talking about their Focus 4 project as well as many other things, including the very important metric ASB returns that's going to take place end of this year. Joining me is, of course, the millennial CEO and Group President of PNB, Jalil Rasheed. Jalil, thanks again for taking time to speak with us. And of course, we are at the World Trade Center, formerly known as PWTC, making this particular video, this particular show. Let's talk a little bit about the MCO and how it has affected PNB.
It's affected us like many other companies as well. So in two forms. The first one would be the staff. So we activated BCP much earlier, before MCO was activated on the 18th of March. And like most people working from home, it was a bit of an adjustment period for the first few weeks. But we've got our rhythm now. So we've moved about 97% of our employees working from home. And then over the last few weeks, when we reopened our branches partially, that number has those coming into the office has increased a bit. But the plan is that we will stagger our employees over a period of months later. On the business side, obviously, I think the issues are well known about how long this economic slowdown would be. How long would it take for SMEs to recover and everything? And I guess for us at PNB, the biggest challenge would be the uncertainty about how long this perception of fear would exist in the market, right? About would people want to freely go out after MCO is lifted? How long would it take for people to get comfortable traveling again? What would it take for people to start consuming and spending again? There's a lot of uncertainties there, and this will then translate back into markets. We've seen weaker markets or very volatile markets. We've seen oil prices drop, simply because it's now become a demand issue, no longer a supply issue. People are staying home, people are not traveling, no one's consuming, all has become cheap, right? So, how long this will take before it gets back to some element of normalcy? It's never going to go back to what it was. That's the question.
See, we have plenty to unpack right there from the opening salvo that you made. Let's start with you being, a unit trust body. It's always important to note that while markets is down, it's not necessarily bad for you guys. In that annual report that you did a few weeks ago, you were talking about now's the best time to deploy some of your capital and to start shopping around. And on top of that, let's layer it with the fact that you have a 30% target to invest overseas. Let's not get and dwell into the past of why it took you guys so long for this target to be achieved, but getting from 8.5% international overseas investment to 30% the next 2 years or 3 years is going to be highly intensive, and it's going to be highly, in terms of activity, you're going to be doing this a lot more in deploying your capital as well as your people trying to find the right markets. Let's talk about the kind of international investments they're looking at. First of all, let's look at asset classes. What are the asset classes that you want to look at for international investments?
So we started our international journey quite long ago, in 1990 actually, where we had an in-house team that was investing in developed markets, so mainly the North American markets. Then over the years, that moved on to a bit of Europe, but then we found that the amount was still not large and sufficient enough for us to kind of wean ourselves over the dependency on Malaysian equities. And we've gone a lot more, quicker and a bit more aggressive in developed markets. Public markets, as in equity and fixed income, will always be a chunk of our investments, about 65% as a total asset class, because of our need to have a lot more liquid assets, because the way we pay out our dividends is from realized gains. So we need investments that
and not many people know that, by the way.
Exactly. So so we need assets that can be crystallized quickly. I often get asked about why not PNB have more in, say, private equity or real estate where the returns are higher. Yes, we can, but once you put your money in, you're locked for a period of years.
But you also have, so to speak, some real estate.
Absolutely, we do.
London, many other places.
But in terms of the exposure, in terms of the percentage, is always going to be a lot smaller than public markets. So that's where asset allocation plays a very important role about knowing what is the optimal mix that we need to have in public markets, real estate, private equity, and the need to deploy on a staggered basis. To give you an example is that if we put money in private equity today, we see a nice payoff after year 7. So essentially we're getting nothing in year 2, 3, 4, 5, 6. So there is a need to kind of bridge the years that we don't have an income in there with by deploying something else. So the way it's been done is that every year something matures, an asset, a real estate asset or private equity asset would mature, and we will get a gain. That is then supplemented with our earnings from public equity and fixed income. The idea is to build a portfolio which is what we call an all-weather portfolio, right? That we have a nice element of defensive, which is bonds. You know, people always say that the returns on bonds are lower these days. Yes, it is. But in markets like this, having some
fixed
sort of
fixed
income is better than having negative returns.
Yeah.
So we want to have that nice balance with fixed income. On top of that, with equity, then private equity and real estate.
So the net effect is trying to create sustainable and sustained income over a period of time.
Correct.
Instead of just a one-off bad payoff at the end of the day.
Correct.
But when you talk about North American markets and other developed markets that you guys are in, it's well documented. It's easy for us to understand what's going on there. And of course, you can also take on, classes of assets that might be interesting for you because other people are doing the same. The issue here is trying to get into developed markets, and you need to get into proper developed markets in Latin America, Eastern Europe, whatever, right? And do you have the necessary expertise to get the job done? Because, after all, these developed markets, you might not be, number one, aware of the situation there, and number two, you might not have enough people to get the job done, to get the investments there.
So which is why when we decided to go overseas, one thing that we did was the outsourcing program. So we are outsourcing money to external fund managers who are experts in the sort of fields that we want to be exposed to. So we're outsourcing money for equity, fixed income, private equity, real estate. And the idea is that we're not going to outsource to the point that we lose all knowledge, right? There is a knowledge transfer program that has been inbuilt as part of those programs where we will send our fund managers to be attached with them for them to learn best practices, process, research, and bring that back, right? Because if we need to be realistic and pragmatic about this, right? The investment universe is very large. And the reality is that having been exposed to Malaysia for a long time, you're just like probably 0.01% of the entire global universe. There's a lot of options out there. And must we recreate every single expertise in-house? No, we shouldn't, right? But we should leverage on the best expertise that's available outside and try to supplement that with what we have internally. And that's what we've done. So I would say internally we have done developed markets quite well over the years. Emerging markets is perhaps an area that we would like a lot more exposure in. And that is an area that we feel that there is a need for us to tap on external managers. Because if you look at developed markets, it's mainly the large English-speaking nations where transparency is pretty good, disclosure is pretty good, lack of surprises coming in from corporate governance
and of course
perspective.
Investor protection is
exactly.
stable.
And then whereas when you look at emerging markets, you've got
Cowboy town,
regulations may not be up to par,
but the returns can be fantastic if you
exactly.
Really, yeah.
So it's a trade-off. It's a trade-off, which is why we need to make sure that we are working with the best partners there to get that sort of returns. So, and then that is on the equity public market side. Then on real estate as well, as you correctly pointed out, we have a lot of real estate, and then we have some London real estate as well. But over the years, it's been a lot of emphasis on bricks and mortar kind of investments. So we've moved out of there by investing in funds, as well as going to sub-segments of real estate. So we've done several investments in logistics and warehousing in Eastern Europe, in Asia, and we're looking something in perhaps Australia and North America as well. So we're going to sub-segments as well. So the way we diversify is let's do it broad-based at a global level. Then let's do it at a maybe sectoral level or regional level, then sectoral level. So that's how we want to whittle our way down.
One thing interesting was that BlackRock, one of the largest, if not the largest, asset managers out there, they are also the world's biggest warehouse owners. And largely because when you talk about, and particularly enhanced here during the MCO or the Movement Control Order, everything is delivered to the home, but where do they come from? They come from warehouses. And because of that, I didn't even realize that warehousing is a big thing that needs to be looked at. Do you guys want to go more of that in terms of when you say, use your lingo, subsector of real estate? Is that the next big thing for you guys?
So we invested in warehousing and real estate way before MCO and the COVID thing came in, right? When we looked at the portfolio, we did realize that okay, we've got a number of real estate in London, but mainly in office, and they've all done very well for us, 100% tenanted, gives us good rental. But there was a need for us to look at what are other segments that would be kind of future proof, right? Whatever happens, there's still going to be demand for it, right? And warehouse was one of those where it's not very expensive to maintain it. It's 4 walls, roof, long tenancy, and it's a very simple business. And that is where we then went around looking for things. We looked at Europe, and we looked at where was the connectivity in Europe. So we looked at where the large trading hubs were and where a lot of the assets were coming from. Eastern Europe was clearly one of the areas where a lot of the logistic hubs were. So we invested in a fund which invests in logistics there. And we've done the same thing in Asia as well, where we're looking at a different kind of logistic investments as well. So we certainly feel that is going to be a sector that will grow substantially. And then if you take what's currently happening as well, could be things like data centers, right? Increased demand for broadband and everything. Again, a no fuss kind of assets. But there is a lot of certainty in terms of demand and recurring income coming from it. So I wouldn't say that we're putting all our eggs into that. That has been the first wave of us moving away from the bricks and mortar office, and we're looking at a lot of other sort of similar complementary kind of segments as well.
Do you have a ballpark figure you want to share in terms of that 30%, what type of asset allocation that you're looking at, and whether or not the mix is going to be a certain percentage in developed markets or emerging markets? What's the story there?
Yeah, so I think developed markets will still be slightly larger for us. Before emerging markets, we're coming off a very low base. The idea is to have a substantial amount there. But I would say that when we reach that 30% overseas investments across all asset classes, developed market would still make easily probably about 70% of it. We do find that when we put our governance filter on top, when we evaluate our investments, there is a bit of a skew, a bit of a slant towards developed markets. To give you an example, is that when we do private equity deals, when we work with external fund managers, we've invested in 15 private equity funds as limited partners. And a lot of the due diligence when we do there seems to point to the fact that from a governance perspective, we are a lot more comfortable with those that are investing in the developed markets. And then real estate as well, because it involves land. So there's a lot of legality issues that we need to be well aware of. And it tends to be much more robust in developed markets as well, right? So it's a step. It's a slow step. We're comfortable in developed markets. We've done it. It's worked well for us. We're happy to put a bit more, but we're not.
I guess risking or jeopardizing of the risk management.
Yeah.
So the question now is, if that is working well for you guys, is there a time and place for you guys to create a more highly intensive department or a division for you to chase after risky assets but high returns?
Yeah. That sort of investments doesn't need to really sit under one department, right? It needs to sit under the various departments that already exist. I think there is a sleeve that we can say, do we want to take a bit of risk in putting something in higher yielding assets, for example, right? To be fair, we're not there yet, right? We're not there yet. And that is something that we will definitely look at, say that when we have reach our 30% target, and that would be the next wave, which is why I was very against having a 10-year blueprint, master plan and everything, which is why our focus 4 was a 3-year initiative because it's a lot more realistic, and we need to be quite flexible. If the market were to turn suddenly positive, within the next 6 months, we need to take advantage of it, right? Maybe we need to kind of change what we had in mind 6 months ago.
Even your 3-year project is kind of derailed because of because of COVID. So it's like 3 months into the whole 3-year thing, and you're already up for a surprise.
Exactly. So, but like you said, in the equity markets, this is a great place. If you're a long-term investor, this is a great time.
You are a long-term investor.
Exactly.
You are into equities. This is the time to do it.
Exactly. So I think there are pockets of opportunity, but we need to make sure that the exuberance needs to sometimes be curtailed, right? Because at the end of the day, we need to think about the sort of risk that we are taking. The sort of returns that we pay out to unit holders, the aim has always been to pay a sustainable rate of return, right? We don't want to, we're not a hedge fund. We don't want to take unnecessary risk there. So we have to make sure that whatever that we do needs to generate that recurring income.
All right, we'll take a short break. When we come back, we'll discuss more about PNB. Don't go anywhere. Welcome back. I am still with Jalil Rasheed of PNB'S. Jalil, we talked about some of the things that you want to do. Let's talk about the things that you are currently doing. One of them is, of course, being heavily invested in a bunch of Malaysian counters. Not many of them are doing too well. Sapura, Valesto, just some of them. And in the annual report presentation that you did a few weeks ago, you were alluding to the fact that dividend income is going to take a hit this year, on top of the fact that last year your net income was down about more than 36% actually. Your gross income is down over 20%. I don't know whether it's going to be the same this year. Do you have what it takes to continue to invest in local companies?
Which is why diversification was a main theme or focus for, because we know that we need to spread the risk around and we need to go overseas. But there are some trade-offs. The dividend income in Asia, Malaysia and then Asia, has traditionally been higher because companies like to conserve cash. They don't like to take leverage. So there is that nice yield coming from that. But in developed markets, we get a much higher capital appreciation, but not much of a dividend income. So that is where the balance comes in. To my earlier point that our returns come out from realized gains, we need to be able to churn out the portfolio in order for us to pay out the returns. So we've done that quite well in developed markets, where markets have risen quite quickly, and there's a lot of liquidity where we're able to go in and out fairly quickly, right? So that will supplement that. And then on the dividends in locally, the other theme was to do value creation. We realized that we own about 11 companies as major shareholders, but there's a lot of value in these companies. We looked at each and every company and then say, are there anything that can generate more value, right? Either operational efficiency or spinning it off or making it organizationally better. There were initiatives in each and every company, and that is something that we are in fairly advanced stages working with these companies, right, in order to generate that value.
I know it's not a fair comparison, but EPF also invests in local companies, but they tend to exit companies they don't like, and it's heavily publicized. You guys don't seem to exit companies, particularly if they don't do too well. What's the story there?
So we categorize companies as strategic and core and trading, right? Strategic are companies where we are the major outright shareholders, the largest ones, the 11 that we have. Then core is where we are not the largest shareholder, we're the second largest shareholder, but we have either more than R1 billion invested or we're more than 10%. And then trading is the others,
in and out,
right?
whatever.
We have been reducing, but your point is correct, and that is where I think we will behave a lot more differently in the future, where in the past our investment universe was very much Malaysia, and we didn't go abroad. So as our fund size grew, we kept on investing in the market, and as a result our cumulative holdings has gotten larger. Now as our investment universe has expanded, not just within equities, but in fixed income, private equity, real estate, then we do need to make sure that whatever that we are churning is then reinvested somewhere else. So we've put in place a capital allocation framework, a discipline, like, okay, we've earned a ringgit from this investment. Where's the best place to put this? It may not be Malaysia. It may not be something on Bursa. It may be a bond, or it may be real estate. So that's where that change of shift is coming. And then we are also on the strategic investment side, and even the core investment side, we're asking ourselves the question is, do we need to hold this much? Right? And the question is, perhaps not. Right? And there is room. Is there room to reduce this? Yes, there is room to reduce this, especially in the core companies and everything. And but that's also a function of how well the market behaves, right? You don't want to be doing it just for the sake of doing it in weak markets like this. But when the markets arise, it's a good opportunity for us to kind of reset that balance a bit. But moving forward, assuming how the market does over the next 5 years, you would see a big difference in how that the concentration in the companies are. And it will allow us to perhaps maybe exit companies a lot more quicker.
So is Sapura Energy one of them?
Sapura Energy, we've, as you know, we subscribe to the rights issue. We own 40% of the company, right? And it's the oil industry is a very tough industry right now. Let's not beat around the bush, right? It's a tough industry. Lower oil prices, low margins, the cash flow cycle is quite challenging as well. We want to do some value creation initiatives there to enhance the value, right? We looked at it, and there are opportunities for us to do, reducing costs, maybe monetizing assets, and there are certain perhaps difficult decisions we need to make, right? Can these companies survive in the same shape or form they are today in order to survive for the next 10 years? That's a question that needs to be answered.
I think, okay, let's do a little case study here. Sapura 101. It used to be a darling of Bursa Malaysia. It used to get a lot of attention, good press, I mean. But of late, even though they got revenue of $6 billion, it's still a net loss of 4 billion ringgit. And since you came on, they have done or taken drastic measures internally, and highly publicized ones. Senior management taking 50% cut, whatever, right? The question now is, do they have what it takes to weather the storm and to be profitable yet once again later on in the future, despite the conditions that we are facing today?
And that's where PNB, as the major shareholder, plays an important role there, right? To institutionalize the company, and add that best practice and governance there. There are a lot of values. There is a lot of assets that's worth quite a bit of money there, which is why I say we need to make difficult decisions, right? Do we still want to be a global player? And this is something that we discuss at the board level.
With 30%, you want to be a global player. That's what you want.
Well, it's. Do you want to be profitable but remain maybe a Malaysia or regional player, or do you want to be making losses as a global player, right? And that's a
tough question.
Yeah,
and you have a higher calling to serve the Bumiputera agenda of PNB.
Yes, and I think on that agenda, this company has proven that it has the ability to go abroad and do projects, right? But then we need to look at it from a risk management perspective as well. Are there something that we need to scale back? The company has, since PNB came on board, embarked on centralization of project management, centralization of procurement, reducing headquarter costs, and putting guardrails to say that at which point do we just walk away from a project because it's no longer profitable, right? Essentially, this is you strip everything out. This is a project management company, right? You're bidding for a project for, say, 500 million ringgit. You have to deliver it at 500 million ringgit. Regardless
at a certain period of time.
At a certain period of time, regardless of what happens. So your costing, your project management has to be on point, right? If anything goes off tender, you can't say, sorry, I can't do it. Yeah. You have to absorb it. And when you absorb it, it eats into your margin, right? And that's where the issue happens. The second one in oil and gas is the cash flow cycle, right? You say you have a project for 500 million, you get paid maybe 10% on the first month. Then you get paid the rest at the end. So in the middle, you've got to fork out your own cash flow. And then you've got other projects that are ongoing in different countries. It's about cash flow management, and that's where the issue has always been with this industry, right?
Late last year, we had a chat over lunch, and you were talking about the idea of the companies that you're invested in, whether or not it's investee companies or many others. You are not the specialist in that area. You are not. While you're invested in Maybank, you're not a banker. Or invested in Velesto and Sapura, you're not an oil and gas guy. You kind of know the companies themselves. They know how they're doing. What is the feedback coming back and forth from? What is the structure of communication that is coming in from the companies that you invest in with yourself? Do you exert significant influence over them in terms of how you want the companies to be done?
So for the strategic companies, the chairman is the PNB nominee. Then we would have other PNB nominees as well, depending on how big the board size is. So typically we'll have 2 or 3 of our PNB nominees there. As shareholders as well, we will engage the board. So twice a year after the board meetings, we will go in as a shareholder and say, this is our analysis of how well you have done or not, and these are the areas we want you to improve. So there is that regular communication loop as well. Internally, we have a team called Strategic Investments that look at these companies. So there's an assigned team that will speak to the Maybank management, to the Sime Darby management and all that, and as shareholders, and that is where we work on initiatives as well. So the feedback loop is pretty good. As a large shareholder, we are consulted on things.
Let's talk about the SIC.
Yeah.
The Lord of the Ring situation, the Fellowship of the Ring, where you have 13 of you, putting your hands together and doing the hoorah thing. What's happening there?
So we had the first one yesterday, right? And I felt there was a need. We never had that before. A lot of
which is bizarre in itself, if you ask me.
So we've always done engagement on a piecemeal basis, but I felt that there was a need when we looked at the businesses. When I came on and I looked at the business and I said, there's a lot of commonalities here in terms of maybe not the businesses, but in terms of maybe
that's why I call it the Fellowship of the Ring.
Different layers, right? Are there? We can definitely play a bigger role if we combine in, say, talent mobility, our sustainability agenda, ESG. Where can we coordinate? Where can we coordinate on other stuff, right? Supply chain, maybe. And so we had quite a big discussion on that. We were very focused on that, and we now have a dedicated team now just looking at what are the sort of people initiatives we can do and the sustainability initiative. We're also working on several other suggestions there. So that was really meant to, the idea of that is not to say this is how all of you should behave, speak and breathe. We don't want that. We like that uniqueness that each company has, and they should. But where there are commonalities, should everyone be doing it 13 times, or can we do it just once? Right? Can we just combine it and do it? And I think that's where we want that synergies to be.
So what would the outcomes you can share with this, if it's not too sensitive to share to the public?
Well, I think it's early days yet, but I think one of the outcomes that we want to have is just to see, are there any areas at the back end that we can collaborate with? Right? And then there are some best practices as well that some companies have done way better than others. And that is where we would like them to share. And those are the outcomes.
You would like them to share. They might not want to share. We've talked about this, prior to your arrival at PNB, we talked about a bunch of things in terms of merger and acquisition of other companies. The sum of 1 + 1 does not equals to 2.
So the best practices that we want them to share is things like, how have they managed talent? How have they managed succession planning and those sort of things, right? Again, we have to be mindful that these out of 13 companies, 11 of them are publicly listed. So, we can't be sharing information freely there. But what we want to do is that, hey, you've done an extremely good job retaining people and doing succession management. Your board is robust, right? You've brought in some interesting people, interesting ideas. Tell us how you did that. share it with us.
This is an interesting conversation. Therefore, we're going to make this into a two-parter. But that was my conversation with Jalil Rasheed. Join us tomorrow for a further conversation with how PNB does its things, including the big question: how is our ASB yield going to look like for this year? Stay tuned for this show tomorrow with Jalil Rasheed of PNB.